Hi, everybody. Welcome to our EarthScan and Capital Dynamics webinar on how to assess climate risks for your solar assets. Please remember that we're here today to discuss EarthScan and its climate risk capabilities, as well as how EarthScan can assess climate risks for solar assets around the world. And indeed, we're joined today to discuss a case study that we've already completed with Capital Dynamics and some of their investments in solar assets. As I say, I'm joined here today by Verena Rossolatos and Linda Monti. Verena, would you like to introduce yourself?
Yes, I'm Verena Rossolatos. I'm Senior Vice President at Capital Dynamics, and I'm the co-chair of the Responsible Investment Committee at our firm. That means I'm leading all the ESG efforts. Pleasure to be here.
Pleasure to have you on the call today, Verena. And Linda is also joining us. Linda, would you like to introduce yourself?
Yes, so I work closely with Verena. My name is Linda Monti. I'm the senior analyst here at Capital Dynamics, and I help with the data collection and a lot of our driving forward our ESG efforts.
Amazing. Thank you very much for joining us on today's call. Really super excited to share as much insight around how you've used EarthScan and what your ESG insights are for our wider audience. As the agenda suggests, I'm going to talk through a bit how EarthScan can be generally used to assess climate risk first off, before we move on to how it can be used to assess those climate risks for your assets. There we all are. Don't we all look handsome? We're moving on as we move forward into introducing EarthScan and climate risk. So on your screens right now, what you'll see is the latest of how EarthScan represents climate risks around the globe. And what you'll understand is across the top, we've got several drop downs which highlight the different climate scenarios that can be utilized within EarthScan to assess the different climate scenarios across the 21st century. What you've also got is the ability to look at several different risk factors on a worldwide basis, whether that is flooding, drought, wildfire, or indeed heat stress. You'll notice that on the right-hand side, the insights and indeed on the map will also change accordingly so that you can understand how climate risks will affect your assets in any given time frame across any given scenario across all of these different risks. And indeed, Capital Dynamics have done this analysis, so I'm really excited to understand more about how this has been done at Capital Dynamics. But how this has traditionally been used is across several different frameworks. So right here in the EU, we have the pleasure of having the CSRD, as well as previously the TCFD, now absorbed by the ISSB. Welcome to acronym heaven. Welcome to sustainability. You can use this for those physical risk portions of these particular types of disclosure requirements. What has also been useful, especially for asset managers in the past, is around that pre-transaction due diligence for either mergers and acquisitions, or to understand what the physical asset exposure is, so that they can understand whether or not to adapt or mitigate or potentially even divest from risky assets. In fact, we've worked with several asset managers around the world to help them improve their ESG understanding of their risks as they pertain to climate change. Finally, and potentially most successfully, we have been able to utilize this understanding in both internal and external risk reporting for organizations around the world. It's our aim that for every asset manager around the world, that they're utilizing some sort of physical climate risk analysis in their sustainability reports to improve their assets and to improve their investment agendas. If they win and they start to invest in assets which are climate risk free, the world wins too. So how can this be used with specifically solar assets in mind? And I think the first thing that I wanted to share, and hopefully Linda and Verena agree with me here, that the renewables sector is a growing market, and indeed solar PV, onshore wind, as well as hydrogen and biomethane are increasingly growing markets. For instance, in Europe, we're expected to install over 260 gigawatts of new wind power capacity by 2030. We'd better get our skates on, guys. That's five years and 1 month to nearly triple the amount of new wind installations. And for solar PV, I work for Motiga Solutions, a Barcelona-based business, and Spain's target for installed renewable capacity is 160 gigawatts. That's more than double what it currently stands at today. So when it comes to ensuring good investment decisions and great location planning for each one of these assets, it's super important that organizations utilize a physical climate risk provider. And this is exactly what Capital Dynamics has done, especially for one of their assets in southern Spain, near Cadiz. And in Cadiz, we've got a solar plant there, and what was provided to us was just a single asset point. And what we've decided to do whilst working with Capital Dynamics is provide an area analysis. And what you can see here on the right-hand side of the screen is a different risk profile than what you would previously have received if it was just a singular point. And so what we've been able to provide Capital Dynamics with is multiple points around this solar plant because there are multiple different risk types associated. So for example, here, the asset that was provided to the asset location that was provided to us was in the light red area. That was an E rating for flooding. And what you'll see here is that there are several areas around the risk which are also at significantly greater risk from coastal or riverine flooding. And so what we've provided is locations across these areas so that you can understand how you may access this asset and how this flooding may affect your asset in the future. Flooding can, of course, be catastrophic, but I want to imagine a future where all organizations and investment managers are utilizing this information to build out more secure, risk-free and sustainable products. We've also done the same in Campo Reale in Sicily, Italy. And in fact, this isn't flooding here, this is wildfire risk. And what we're able to show here is that there is significant wildfire risk towards the north of this solar plant, which may affect access to the plant itself. In which case, if there is significant wildfire, there may be significant increases or in operational or financial losses associated with the solar plant. The way in which we did this was just to essentially provide this 10-kilometer square grid and select where those significant risks are most related to the assets on the left-hand side. How can we move forward and how can we increase this knowledge sharing and incorporate it in such a way that it can be utilized across the business is, well, first and foremost, is by sharing this information in as many different varieties of formats as possible. I think we're all used to what flood maps may look like, especially when looking at different assets around the globe. But what you can see here on the right-hand side is the Rome's Fiumicino Airport. Rome's Fiumicino Airport, if we were to select a single area on the left-hand side, so this terminal building here, we may miss completely the fact that it is exposed to flooding on the right-hand side here, towards the east, on their actual runway. This is super important for airports. Now imagine if you can transfer this knowledge to solar plants around the world. And finally, the way in which this is currently developed is now that we're able to provide globally anywhere on Earth a depth meterage chart in flooding maps so that you can start to understand how inundated from either coastal or riverine flooding your asset may become in the years to follow. So with all that in mind and all of the use cases that I've just shared there, hopefully that wasn't information overload for anybody watching this. I would love to start a conversation with Linda and Verena around how EarthScan has been utilized and how Capital Dynamics see ESG. So with the first question there, and if I can ask one of my two joiners to answer this question, how do you integrate climate risks into your overall investment strategy and process?
Yeah, great question. Thanks, John. So our integration of climate risks started actually very early on in our responsible investment journey at Capital Dynamics. Already in 2018, we implemented our proprietary ESG scoring system. We call this the RI rating system. So that's a rating system that's designed to review a specific set of responsible investment matters, assess sustainability risks and opportunities, of course, and ultimately provide transparency to our clients. So each investment that we make, regardless of the business line, is rated on a scale on this RI scorecard. And that's a scale that ranges between 0 and 5. So we take this as a measure to see, like, well, what are our highest performing ESG performers? So those are the assets that are rated with a 5. And those with the highest ESG risk or the lowest ESG performance are rated with a 0. Now, in most cases, this type of investment this type of ratings is based on standardized due diligence questionnaires. They were developed by our investment teams in conjunction with our responsible investment committee. Now, this RI rating system allows us to assess and track key ESG factors, including those matters that are pertaining to climate risks, such as transition risk or physical climate risks. Now, that was the very, very big milestone for us in our responsible investment journey. But then the next milestone in terms of specific climate risk assessment, that came about in 2020 when we started to endorse the TCFD framework. And you touched upon this, John, earlier, the TCFD framework, that's the Task Force on Climate-Related Financial Disclosures. It's essentially a framework that contains 11 disclosure recommendations, together with helpful guidance for asset managers and asset owners on how to think about climate-related transition risks, physical risks, and climate opportunities. Then a year later, in 2021, we started performing a qualitative scenario analysis as part of our TCFD assessment framework. And we did this primarily based on our sector exposure in terms of climate risks. Then the following year, in 2022, we improved our approach by integrating open source physical climate risk models. And those are the type of models that project risks, so that's physical climate risks, across various scenarios over the short, medium, and the long term. However, the problem with these type of models is they present challenges due to their regional nature. These type of open source physical climate risk models usually cover either very large regions or even entire countries. So that makes it really difficult to pinpoint the risks at a specific asset site. Now, to address this, we implemented Mitiga's EarthScan climate risk screening tool in early 2024. And you saw this very nicely on the screen beforehand, John. You can really see how this geolocation precision of the EarthScan tool can allow you to really assess the risk at the asset level side. So in that way, we can ensure that climate risks are considered before and during the life of our investment and what really matters to that specific asset side.
Amazing stuff. It sounds like it's been a hell of a journey, but hopefully a very worthwhile one. Thank you for that, Verena.
Definitely.
We're moving on to the next question now, and we've got, can you share some examples of how you have built climate resilience into your investment strategy and any projects or actions you have taken to enhance climate resilience within your portfolio?
Yeah, and I can take that one. So how we do it is we actively build climate resilience into our clean energy investments by incorporating a variety of climate adaptation measures. So for instance, at our solar energy sites, we use Tier 1 AAA solar panels, which withstand temperatures up to 65 degrees. That reduces the risk of heat-related degradation. We also implement vegetation management strategies, such as clearing dry vegetation and establishing fire breaks along perimeter fences to minimize fire risk. Additionally, we equip all solar assets with weather adaptive trackers that adjust panel angles to optimize efficiency and cooling. This also ensures resilience against extreme weather events, and all of our assets have detailed emergency preparedness plans for fires, floods, high winds, and other risks. Finally, our wind turbines are built using highly durable materials, and this contributes to the longevity and reliability of our clean energy projects, even in those challenging climates.
Amazing stuff. No, I think from my side, what is really heartening to understand as a relative energy novice is to understand that there is so much thought and analysis going into how we can ensure that these products, which are assets, sorry, which are making us more sustainable, continue their life cycle and continue to make our societies as sustainable as possible. So we're moving on to the next question. How are you innovating your investment products to enhance both climate resilience and value creation?
Yeah, so I can take this one as well again. But so we are driving innovation through the impact targets embedded in our clean energy funds, which are designed to support the goals of net zero while delivering strong financial returns. So our first impact target is to achieve an average ESG score of at least 4 for our investments. So this is out of a possible 5, utilizing our proprietary RI rating system that Verena had previously discussed. In 2018, our firm established the RI scorecard to assess and monitor the ESG performance of our investments. So each investment is rated on a scale from 0 to 5, whereby 0 represents high ESG risks and 5 represents low ESG risks or strong ESG performance. So therefore, achieving an average score of 4 for our investments as part of our impact targets helps us identify investment opportunities and assets with robust sustainability performance across environmental, social, and governance factors. And so the second impact target focuses on implementing decarbonization actions at the asset level. So that's aimed at reducing emissions during the construction and operation of our solar and wind assets. These initiatives not only strengthen the resilience of our portfolio against climate-related risks, but they also unlock value by improving operational efficiency, lowering costs, and increasing the longevity of the assets. So this dual approach aligns our financial goals with our commitment to sustainability, creating a win-win for both the investor and the environment.
Awesome stuff. I think that's something that we can all get behind. Moving on to the next question, we've got what is the expected return on investment of building climate resilience within your portfolio? And frankly, do you encounter any internal or external pushback?
Yeah, interesting topic. Climate resilience is definitely something that becomes a really, really important topic as, of course, the physical climate risks continue to rise. And it's really important for the listeners to understand that building climate resilience into our assets not only mitigate risks, but it also creates value. So, for example, when we reduce exposure to extreme weather events like flooding or wildfire risk, and while also improving operational efficiency, we can lower insurance premiums, we can lower operating costs, and we can lower potential revenue losses. And while external stakeholders, for example, investors, increasingly recognize the importance of resilience, at Capital Dynamics, we also focus on really communicating the financial and environmental returns clearly. And that's going to be increasingly important because as climate risk grows, so does the alignment between sustainable practices and financial returns. So making climate resilience really a sound long-term investment for both profitability and positive impact.
Amazing. No, I think when it comes to long-term nature, we need to imagine that climate change, whilst it is here with us now, on our current trajectory and with the current scenario analysis, we're already missing the Paris-aligned targets. And therefore, there is, as you say, there is going to be an increase in extreme weather events associated to climate change. And by taking this into consideration, you are building climate resilience into your portfolio. Absolutely love it.
100%. And adaptation remains like a really hot topic. And we are very, very pleased to see that, well, a couple of years ago, I guess climate mitigation was really like front and center of everyone's mind. But now it's really the adaptation as well. And it's good to see it's the right movement, really, because we all need to adapt to a changing climate. That's reality.
Absolutely. From my side, I would love to move on to the next question around policy and regulation. We've already highlighted the TCFD, but what changes in policy or regulation do you hope to see that could impact the future of climate resilient infrastructure investments?
Yeah, great question. So I would say one of the most significant changes that we anticipate is the implementation of the ISSB standards. So ISSB, those are the International Sustainability Standards Boards. These are these are specific standards that are designed to enhance ESG transparency. And as these standards gain traction, we also expect that there is going to be a greater regulatory focus on climate resilient infrastructure investments. Likely, this will involve then stricter reporting requirements on how climate risks are managed, and also about the integration of climate-related data into the investment decision-making process. But ultimately, this increased transparency will then push firms to adopt more robust climate adaptation measures, and then potentially accelerating the flow of capital towards resilient infrastructure.
And of course, Capital Dynamics is already ahead of the curve by utilizing a climate risk provider like EarthScan.
100%.
Fantastic. And the next question is, how do you see the role of climate risks evolving in the asset management industry?
Yeah, so I can take that one. So the asset management industry is becoming more sophisticated in its approach to climate risks, recognizing them as central to long-term investment performance. So there's a growing shift towards proactive management of these risks, from better physical risk screening to decarbonization strategies aimed at mitigating both regulatory and financial exposures. So with the introduction of standards like the ISSB, we expect an even stronger focus on climate resilient infrastructure investments in the near future. Additionally, there's an increasing awareness of the interlinkage between climate risks and biodiversity risks. So climate risk exacerbates biodiversity loss, while ecosystems like forests and wetlands play a crucial role in mitigating climate change by absorbing carbon. For renewable energy asset managers like us, it's essential to manage these interconnected risks. Our solar and wind projects, for example, often involve land use, and this could affect local ecosystems. By incorporating biodiversity risks into our thorough ESG underwriting process, we ensure our assets are not only resilient to climate change, but that they're also supporting the preservation of critical ecosystems. So this dual focus on climate and biodiversity risks helps us safeguard our investments from potential regulatory, environmental, and reputational challenges while contributing to a more sustainable future.
All that remains for me to say is to say thank you to Verena and Linda for joining us on today's call, and thank you for answering those questions that we shared with you today. Hopefully, as a member of our audience, you've learned something new, and if you would like to learn anything more about either EarthScan or Capital Dynamics, please see the information that's been shared in the email alongside this recording. If you're in the US, I wish you a very happy Thanksgiving weekend. And if you don't see this until after the holidays, I hope you had a restful holidays as well.